career in property began when he worked at Ernst & Young's Real Estate Hospitality and Construction Division. In that role, he had extensive exposure to clients such as Meriton, AMP Capital, Westfields and McGrath. Unlike most of his peers, Eric is not interested in treating his clients as a transaction, as he believes in long-term relationships built on trust and honesty. The time Eric spends advising his past clients is a testament to his dedication in nurturing client relationships. Eric is currently on the management committee of both the Sydney High Old Boys Union and the Sydney High School Foundation. He is also the elected treasurer of both the associations. Eric is always looking for ways to give back to the community, and this year he is sponsoring the Chatswood High School Junior Dance. Please welcome Eric.
Hi there, everyone. Thanks for coming. I'm the last presentation, so hopefully I don't take too long. I think they're going to start serving lunch soon. My topic is rental yield or capital growth. How about both? At this stage of a seminar, usually you have a real estate agent comes and go, we've done all the research, this is the one you have to buy. Guarantee you're going to make 20% at the end of the, when it's finished. And we all go back and we pay for the bills using the money you buy my purchase, the property for. But what we do at Bond Partners, we actually want to educate you in understanding how to make money in property. And to do that, my presentation will actually hopefully help. So firstly, why are we all here? Why we even invest in property? A lot of you might be going to work every day, 9 to 5, stuck on the train, You can see there's a lady there that probably doesn't want to be there, but she has to be there. Whereas on the right-hand side, you got young couple spending time with the kids. I have a young daughter myself, and I'd love to spend more time with her. I mean, who wants to work when you can spend time with your family, right? So just think about why we're actually doing this. Like, this is why we're doing it, to actually look after our family, people we love, safeguard their well-being, and build a future for everyone. Just some housekeeping. I'm assuming most people know what rental yield is and what capital growth is, but if you don't, that's a quick example. If you have a property that gives you $500 a week, that's $26,000 a year. If the property purchase price is $520,000, you get a 5% yield. Simple. It's simple. And the capital growth, say you purchase a $520, property sale price when you sell it is $624. The profit is $104. You do the difference, and the capital growth is 20% by the difference divided by original purchase price. Just to give you an idea what rental yield and capital growth is, in case you haven't done anything like that before. Okay. The common belief people have is you have to sacrifice rental yield for capital growth. High yield means less capital growth over time, like really boring areas that's not established yet, like it's not growing much, but the rent is okay because the price is low. And for example, if people buy shares, you might think about blue chip shares. They always go, if you buy CBA, etc., you get your 5% yield every year, but then you won't outperform the stock exchange. That's the common perception. And for capital growth, high growth area means less rental yield. So for example, like the CBD, etc., you might buy an apartment for $100 million, and the rental yield might be $700 a week. Whereas if you buy out west, you get two property, $500,000 each, and they each yield you $500 a week. So people might think, because it's a more exciting area, there's potential growth, everyone likes it, it's popular, then you get high growth, but you have less rental yield over time. For example, startup companies, there's no dividend, but you outperform the market. When you invest in a property, you usually look at long term. So from year 1 to year 15, you can see if you purchase something for $520, let's say 6% growth. I'm more ambitious. I'm a real estate agent, so I'm a bit higher than the mortgage broker. So 6% growth every year, you get to around 1.1 in 15 years' time, which is about normal in the Sydney market. When you think about 15 years ago, when you buy a property of $500,000, it's probably worth around $1 million now. And rental growth, if you already have an investment property, I'm sure you understand most rental yield actually increase by around $20 a week if the agent does the work properly. If they're not, talk to me, and I'll make sure you get at least that $20. But realistically, that's how much you will get. As you can see, capital growth will be over time, and your rental yield actually keeps dropping the more the property value goes up. So that's why when you have a so-called upcoming market or suburb, after you've gone up and you buy it when it's already up, your rental yield is actually lower. But all the capital growth is already there. And over time, regardless of good year or bad year, in the long run, over 15 years, most property do double in Sydney. For the same deposit, say if you have a $1 million deposit for $1 million, you have $200,000. Instead of buying one property for $1 million, you buy two for $500,000. You can see that your return, assuming everything is the same, the graph we have, which is pretty normal, $1 million property nowadays gets around $700 or $800 rent. So this is actually reflective of the current market. When you look at it, 25 years later, when your loan is fully paid off, in both scenarios, one, you're out of pocket by $570,000. The other one, you actually start earning money towards the end of the life of the property, and you actually get $85,000. So over the life of your property, you actually don't cost you anything. They actually pay you money. And the profit of $3.9 million, you will see what I mean by that. So that's another graph showing how your actual yield is actually reflective of deposit or the return. So if you buy a high yielding property now, and your return on deposit is actually significantly higher because as you saw from the previous graph, it's around 2,000% compared to 17. So 17 times and 20 times. To put in number, it's around $1.5 million more per property you buy. So this is the numbers. Most real estate agent would tell you, property prices grow and it will always grow over time, 6% a year, which is reasonable for 25 years. But I just want you to have a look at what that actually means, because a lot of people don't actually do the calculation, what it actually means, 6% per year over 25 years. If you have a $500,000 property, after 25 years, it's going to be worth $2.2 million, supposedly. But if you look at a property that's worth $1 million now, it'll be worth $4.5 million. Everyone has to think about when you're buying a property now, say a 2-bedroom for $1 million, can you see the market supporting $4.5 million valuation in 25 years when we're actually getting wage growth around 2% a year, if you were lucky? So that is the risk that you have to consider. When you're buying a cheaper property, if it goes according to plan, you make more money, and it doesn't actually cost you any money throughout the period, or that over 25-year period. Whereas if you buy a more expensive property, the rental yield is lower now. Plus, you have to assume that the property is going to increase to $4.5 million from $1 million. Whereas the other one is only $500,000 to $200,000, $2 million. Regardless of whether or not it goes to that $2 million, over that 25 years, it actually gave you $85,000 return. That is yours to keep, no matter what happens. Even if the property price does not move at all, you still make $85,000 over 25 years. Whereas the other scenario, you actually lost $600,000 hoping that the property market would have gone up by the time you want to sell. So that's something you should consider when you're investing in property. So how do you get both rental yield and capital growth? As you can see, it's just simple. Forget about all the hype about potential growth. Focus on the current yield and buy it now and just hold it. Most of you here can afford a property that's $500,000. I have no doubt. I mean, you pay 10% deposit, $50,000. If you're just 20 years old, your parents have a home, release the equity from house mortgage, refinance it, let them help you. Like I always tell my client, it's actually true because there's a lot of my clients where they have a fully established home, fully paid for. And I told them, to help your kid to really establish the saving habits, etc., just refinance a home for $50,000. It's not a lot of money. $50,000 repayment now, if you're doing interest only, is $100 a week. And I always tell them, if your kid cannot earn $100 a week doing part-time while they're in uni, you should kick them out of the house and let them literally learn how to live. Because if they can't save $100 a week while they're at uni doing part-time, you're not really helping them and establishing them for the real world when they graduate, because everything costs money in this world. And so that's what I mean. Like if you look at it, just buy whenever you can and just hold it. In 25 years, no matter what happened, don't think about selling it when every time it goes up by 10,000, 20,000, 100,000. It doesn't matter, because once you sell it, you start to buy the same market. When you think about it now, with thousands of apartments being built everywhere, 2 years later, you might think you go up by 10%, but there's 2,000 people that swing it exactly the same. Unless there's 2,000 people that will buy the same complex for 10% more than what you pay for, the chances are the price will start going down, because some people just want to take a profit and run. And lastly, just remember, investment is a numbers game. The key is patience. It's about holding. It's not about running as soon as you see a little bit of profit. a lot of people I know, they go, oh, I wish I didn't sell my home 5 years ago. Look at it now. Did they need to sell a home 5 years ago? Probably not. Why did they sell? Because the agent called them, oh, your apartment went up by 200,000. You're interested in selling? Oh, that's a lot of money. And then what happened? After you sell it, when you consider stamp duty, interest, agent's commission, your capital gains tax, you might be making like 50,000 out of that 200,000. And if you held that property, I don't know, anywhere you buy before, if you hold it for the last 5 years, $50,000, I can guarantee you it has gone up by that much. No questions asked, no matter what you buy. So forget the following when you're investing. A lot of clients I see, they go, oh, would I live in it? Like, I can't picture myself living in it. This is not an area I want to live in. But when you buy investment, it's not about whether or not you want to live in it, because people are living in it. And if the market rent is there and people are paying their rent, that's all you care about. Why does it matter if you're not living in it? Like, as long as they can pay you, and if the market rent is at an X amount, obviously the market can support it, then you just buy it and treat it as a number. Not, if you always think about, living in it or buying it, it's not called investing, it's called living in it. So the next one is, would there be capital growth? If the holding cost is affordable, the capital gain will come, as you can see in the graph. No matter what happens, the main thing is, are you actually putting money in and losing money throughout 25 years in the hope of making money? Because I think I put up there, casino is legal in Sydney. And for those of you who are patient and you want to make money quick, go to a casino, it's probably around the same. Do your own research. Seriously, there's a lot of advertisement out there going growth. Like, I saw an ad the other day, it goes, this suburb is one of the top 100 suburbs in Sydney right now. And I'm thinking, one of the top 100 suburbs, I think in Sydney there's only like 200 suburbs. So, if you're top 100 suburb, you're like not even the half. And then you look at the return, it's like 2% growth capital. And it's like, but catchy headlines like that grabs attention. And people always go, oh, it grew like 20% in the past 3 years. And so anyone that invests in anything knows if something grew about 20% in 3 years' time, the chance of it going under 20%, you might put it waiting under 20. So, and if you're losing money from the rental yield, why would you wait another 10 years just to make that extra 10% or 20%? Because the growth is already there. You already missed the boat. And if you try to catch the boat, the only one that makes money is the person selling it to you or the developer. So on a final note, I'm sure you have seen this many times. If it sounds good to be true, it probably is. So that's my one message when you're investing. And yeah, I got a disclaimer too, because obviously I don't want anyone suing me going, oh, you guarantee me 6% growth. I bought a property 20 years ago and it grew 1% a year or something. So anyway, we got lunch going to be served soon, and if you got any questions, just come to us during the lunch period, and then we're happy to talk to you. So enjoy.
On behalf of Bond Partners, we would like to extend our warm thank you for attending today's seminar. Thank you very much.